I think the heart of this problem was the real estate bubble that started in 2002, 2003, 2004. There were a number of reasons for this. One, of course, is the low interest rates that existed. And by the way, I don't think it was all Greenspan's, to blame Greenspan for those low interest rates. I think there were a lot of really international forces that in play that drew that interest rates down. But what that did is made people very hungry for yield, to get higher yields, get the type of interest rates that they were getting before the break downward in interest rates. And with home prices rising, people suddenly began to think, well, let's go to the mortgage market that are collateralized, that are backed by homes. Homes seem to be sound investments. Home prices had rarely, if ever, gone down in nominal terms, if you look at the historical record. So it seems that loans that were backed by homes were ones that you should get. Now, of course, if you want to get a higher interest rate, you just don't take the conventional loans that are backed 20%. You got to take those loans of borrowers that are not quite as good. Take loans of 90%. Take loans of 100%. Not only were the interest rates higher, but the fees were higher for delivering these loans. And so suddenly was born the market for subprime and what's called Alt-A mortgage instruments, not just in the billions, but in the hundreds of billions, that found ready buyers out there that said, I want higher yields than the 1% that I get on my money market. Remember, Fed funds was down 1% for a year and a half, or even the 3 or 4% I can get on government bonds. Now, investment banks made a lot of money out of packaging these poor loans, these subprime loans, selling them out there. They could have, and they should have, sold them very quickly. I mean, there's one thing about getting the fees from processing, and another thing about holding them. But many of them decided to hold them in addition because they were good investments. Right? And they did so with ever, okay, I guess we're turned off here, ever increasing leverage. So they were buying these subprime, they were creating these subprime mortgage securities that was backing this real estate. They were getting high interest rates, they were getting high fees, and they were levering this by 20 to 1, 30 to 1, and even 40 to 1. Now that doesn't give you much of an error. If the price of those instruments just goes down a few percent, you're going to get into deep trouble. Now, that is precisely what happened, is that back last February, they noticed that these subprime mortgages were not paying, the delinquency rate went way up, and all of a sudden they said, this is not worth the price. And the investment banks were found to be holding a lot of these. Some tried to get rid of them, but some said, just a minute here. If I look at the market's down a lot. I think it's down too much. A few of the investment banks then decided, we have the expression double down. You know, I'm going to double my bet. I think these things are too far down. I'm going to borrow some more money and buy even more of them. And of course, what happened is that they continued to go down afterwards. Now, this is the main cause of why these firms had to be liquidated. And we take a look at Merrill Lynch. And it wasn't liquidated, it was sold into Bank of America. It wasn't because people weren't using their brokerage facilities. It wasn't because they weren't using their investment advice or any of the other functions of Merrill. They were using those. The problem was the balance sheet. They had bought these bonds. They didn't get rid of them because they thought the price was too low. And all of a sudden, they found their balance sheets underwater when you look at a market basis. That is the problem. It's not a problem so much with the services they were selling. Certainly the subprime services, no one's going to buy subprime loans anymore. And that was a source of increase in income. to the investment banks in 2004, 5, 6, 7. But only one part of the increase. I mean, there was a lot of international activity. There was a lot of IPOs. In other words, there was a lot of activity going on that caused an increase in their profit. But the subprime was one of them. If they got rid of them, if they had sold them, just originated them and sold them, they would be in a very strong position today. You probably read about Goldman Sachs. One of their divisions actually bought them and held them. Another division said, these things are bad, let's short them and sell them. The division that shorted and sell them made enough profits to offset, basically, the loss in the value on the other division. That is one of the reasons why Goldman Sachs ended up in one of the best shapes of all of them. But what we see now is, I mean, Dick Fowler, Lehman Brothers, they were all masking the decline. They didn't want to admit how far down these financial instruments, and in some cases, as I think Joe was going to talk about, the property that they held, particularly on Lehman, had gone. And when Wall Street and traders saw how far down it went, they said, whoa, you are insolvent. You don't, you know, your balance sheet has negative net worth. You know, you're going to have to go into liquidation. Now, I'm going to talk a little bit about why did the Fed bail out some of these institutions and not others? And that's very interesting, too. And what's the difference between Bear Stearns and Lehman? Not very much. Maybe we should say 6 months. Bear Stearns was in March, and Lehman here is in September. Lehman had access to certain facilities that were not in play when Bear Stearns went under, particularly the primary dealer credit facility that the Feds put in place just a day before they folded Bear Stearns into J.P. Morgan. There was more time for them to adjust their position. There was more time for them to finance the counterparty risk that was there. And let's face it, it's an election year with elections 6, 7 weeks away. There was increasing criticism of bailing out the big guys over here. And I think the Fed began to get sensitive and said, listen, Lehman doesn't provide systemic risk. We can let them go under. They did the same thing at the beginning for AIG. But AIG works out differently. This all played out today. AIG is much bigger than Lehman. AIG insured hundreds of billions of dollars of these mortgage securities, not just 20 billion, 50 billion, 100 billion, as Lehman did. The whole credit default swap market, which I'm not going to go into, but it's grown into the trillions of dollars, would have been thrown into chaos had AIG gone under. That was the pressure on the Fed today. At first they balked, saying, we'll let AIG go. As the day went on, they began to realize maybe we cannot do that. I wrote this morning that it was much more important for the Fed to solve the AIG problem today than to lower the Fed funds by 50 basis points. When they didn't lower them by 50 basis points, the market went down 100 points. When there was a rumor that the Fed had made a deal with AIG, it went up 250 points. So it did respond much better to that situation. They're going to have to make some sort of deal on AIG. We hope AIG is the last one. And I think it is, if you take a look at the impaired balance sheets on the books. Others have some problems. I think that's the last big one. Finally, a few words about results. Who's getting bigger? The commercial banks. Why? Well, not of course, we're buying Merrill, they're absorbing Bear Stearns. But very importantly, they have direct access to the Fed, the ultimate source of liquidity in the markets. All these other dealers, yeah, they can borrow, maybe they can, but it is the primary responsibility of the Federal Reserve to make sure of the integrity of the commercial banking system. And they will lend as much as necessary to make sure that all the deposits are safe. This means the banks are going to get bigger. Over the last 50 years, they've lost business to the investment banks because people said, oh, we don't need banks. We can go directly to the public. The public is willing to give us money. Well, now risk premiums have ballooned upward. A lot of these deals are going to go through the banks now, the investment bank division of the banks. And of course, when times get back to normal, these investment banks might be spit out again. You know, we're seeing a change in the players. Lehman was bought by American Express, then spit out. I mean, this is, you know, they're going to be mixed in, spit out over time. But the immediate situation, obviously, is an increase in the commercial banks. Let me end with this, because I'm sure we're going to get into some of these with discussion. As I pointed out in my article, Wall Street Journal today, there's still huge demand for financial services. Not quite as much as there was a couple years ago, because the subprime market, which was very profitable and obviously ballooned from nowhere, you know, back in the early part of this decade. Remember, and iBanks were very profitable before we even heard of a subprime mortgage. They didn't absolutely need them. They just got more profitable as a result of issuing those. But the demand for financial services is going to grow. Internationalization, international flows of credit are going to be bigger than ever. What we're going to see is a downward adjustment now, and then we're going to go back to the trend line that has really been going over the last 20, 25 years, and I see no sign of breaking up. So we are repackaging, and in one way, let me just say that how much better off we were than Japan, which suffered a terrible real estate collapse in 1989, 1991, never admitted their problems. They stayed for a whole decade in a slump as a result. No one admitted the loans were bad. They kept them on the books forever, hoping they would pay. They had a frozen banking system. I know Dick Herring knows a lot more than I do about this subject, might talk about it, but we are now making transparent what these instruments are worth. We're doing the type of reorganization that is necessary. We're going to get healthy as a result of this far faster than Japan did, and these financial service jobs are going to continue.